Sometimes trying to figure out what a stock is really worth, it feels less like smart investing and uh, more like trying to decipher some ancient language.
Yeah,
You're looking for that core value, that solid ground, but, well, you can quickly find yourself drowning in spreadsheets and just endless data points.
that's a really common feeling. I mean, the information overload in the market today can be pretty significant. And separating the signal from the noise, that's a real challenge for any investor.
Right. Which brings us to today's deep dive. Forget wading through every single ratio and indicator out there.
Yeah, let's get through it.
We're going straight to the heart of stock valuation,
Yeah.
the discounted cash flow model, or DCF.
Exactly. Our goal here is really to clarify some of the, let's say, intricacies and even the disagreements surrounding this fundamental valuation tool.
Okay.
We want you to not only understand how it works, but also, what drives different investors to interpret its outputs in such, well, varied ways.
And we're going to do that by really examining the DCF model itself from the inside out. Think of it maybe as an X-ray of a company's financial engine.
Good analogy.
Our mission is ambitious to gain a truly robust understanding of this cornerstone concept. Okay, let's unpack this. Why is the DCF model so foundational in the first place? Where did it come from?
Well, it's interesting. While the formal structure of the DCF model, as we kind of know it, emerged in the 20th century, its underlying principles, they have much deeper roots.
Oh, really?
Yeah, the concept of compounding returns, that was understood way back in ancient times. And even Fibonacci's work in the 13th century, believe it or not, touched on ideas related to the time value of money.
Wow, okay.
But the formalization of these ideas, specifically for stock valuation, that really took shape with John Burr Williams' groundbreaking 1938 book, The Theory of Investment Value.
1938. Okay, that's a period marked by immense economic turmoil, right? The Great Depression. That timing seems significant. It's absolutely crucial. Before the DCF framework, market thinking often leaned, well, heavily into speculation and sentiment. Keynes famously compared the stock market to a beauty contest, where the goal wasn't to pick the best company, but to pick the stocks others would find attractive.
Right. Predicting popularity.
Exactly. And the devastating crash of 1929 and the prolonged depression really underscored the inherent risks of those purely speculative approaches. There was a pressing need for a more grounded, more rational method to figure out a company's actual worth.
So Williams essentially said, look, there has to be a more logical way than just trying to, predict the next hot stock.
Precisely. Williams' central idea was simple but powerful. A stock's intrinsic value is the present value of all the future dividends it's expected to generate.
Okay.
Later on, in 1951, Joel Dean significantly popularized using DCF principles for capital budgeting decisions, which kind of broadened its application. But Williams really laid that fundamental groundwork for valuing equities based on their future cash-generating capacity. It's fascinating how a major economic crisis spurred the development of this more fundamental approach. It makes you wonder if that speculative casino mentality ever truly disappears, doesn't it? Especially with the market swings and bubbles we've seen in more recent times, like 2000, 2008, even the volatility around 2020.
That's a very insightful point. The allure of quick gains through speculation, it's a persistent feature of markets.
Yeah.
And that's exactly why the core problem, Williams addressed the need for a rational framework to assess value, remains so vital today. We keep seeing these periods of market exuberance and sharp corrections where understanding that underlying value becomes absolutely paramount for long-term investors.
And the DCF model itself, it's adapted since Williams' time, hasn't it? I mean, lots of companies today focus on things like share buybacks, not just paying dividends.
Exactly right. While Williams' original focus was squarely on dividends, the model has evolved, thankfully, to reflect these changes in how companies return capital to shareholders.
Makes sense.
So now we commonly use metrics like free cash flow to firm FCFF and free cash flow to equity FCFE. These capture a broader range of cash flows available to investors, including, crucially, the cash that could be used for buybacks.
Okay.
The core principle hasn't changed. It's still valuing future cash. But the definition of what relevant cash flow we're looking at has become more inclusive.
Now, thinking about today's environment, we've had these prolonged periods of very, very low interest rates, and particularly for high-growth companies, does the traditional DCF model still provide a reliable framework?
That's a critical question, and honestly, it's a significant point of debate right now.
Okay.
When discount rates are exceptionally low, the sensitivity of a DCF valuation to those long-term assumptions, especially growth rates way out in the future, it gets amplified. massively amplified sometimes.
Right, small changes make big differences.
Exactly.
Yeah.
Even minor tweaks to those long-term growth expectations can lead to substantial swings in the calculated present value.
Hmm.
Some argue that for these really rapidly growing companies, the traditional DCF might not fully capture their potential to disrupt markets or, the value of future options they might create down the line.
Hmm.
However, the fundamental logic, discounting expected future value back to the present that still holds. The challenge really lies in the reliability and, frankly, the appropriateness of the inputs,
Yeah.
which are subject to much more intense scrutiny in these low-rate environments.
Okay, so we see the historical necessity, the evolution. Now let's get into the nuts and bolts. What's the fundamental theory that underpins how it actually works?
Right. At its core, as we've kind of touched on, the DCF model operates on that principle of valuing future cash flows in today's terms. It explicitly recognizes the time value of money, which is just a simple idea that a dollar or a pound or a euro received in the future is worth less than one received today. And this difference in value comes from things like potential investment opportunities you miss out on, inflation eroding purchasing power, and just the inherent uncertainty tied to actually receiving that future dollar. You'd probably prefer money now so you can invest it and earn a return. Right?
Absolutely. So future money gets a discount to reflect that lower present value.
Precisely. And the basic mathematical expression of this looks like this. The DCF value equals the sum of the expected cash flow in each future period. Let's call that CFT divided by 1, plus the discount rate raised to the power of that period.
Yeah.
You do that for all the periods in your explicit forecast horizon, say, in years. Then you add the present value of the terminal value, or TV.
And the terminal value is?
That represents the value of all cash flows beyond that explicit forecast period, also discounted back to the present day.
Okay, that's the formula in a nutshell. Now, you mentioned different flavors of cash flow earlier. Can we clarify those a bit?
Certainly. First, we have free cash flow to firm, or FCFF. This is the total cash flow generated by the company's operations that's available to all its capital providers, both debt and equity holders.
All of them. Okay.
Right. And that's after accounting for all operating expenses, taxes, and the necessary investments in things like working capital and fixed assets. Because it's for everyone, this FCFF is typically discounted using the weighted average cost of capital, or WACC.
The WACC. Got it.
Which reflects the average rate of return required by all those capital providers combined. Then there's free cash flow to equity, or FCFE.
Okay, different focus here.
Yes, this is the cash flow available specifically to the company's equity shareholders. After everything else, expenses, taxes, reinvestments, and importantly, debt payments have been made.
Right.
So FCFE gets discounted using the cost of equity, often denoted as KEY, which represents the return required specifically by equity investors for the risk.
And the last one?
And finally, the original approach, the dividend discount model, or DDM, focuses solely on the expected stream of future dividends shareholders expect to receive. So notice, the choice of who you're focusing on, all capital providers or just equity holders, directly influences the cash flow metric you calculate and, crucially, the discount rate you use to reflect the specific risk they bear.
That connection between the cash flow type and the discount rate is much clearer now. So this discount rate, or in the formula, how do we actually determine that number? It seems pretty critical.
Oh, it's absolutely critical,
Yeah.
and often a point of debate, as we'll see. For FCFF, as I mentioned, we use the WACC. Think of it as the average rate of return a company needs to earn on its existing assets just to compensate its lenders and shareholders for the risk they're taking.
Okay.
For FCFE and dividends, we use the cost of equity, KEY. A very common way to estimate this is using the capital asset pricing model, or CPM.
CPM, right. Heard of that one.
Yeah, the formula is KEY equals the risk-free rate, RF, plus beta, multiplied by the equity risk premium, ERP.
Okay, let's break that down. RF.
RF, the risk-free rate. Typically, people use the yield on a long-term government bond, like a 10-year treasury. It's meant to represent a theoretically riskless investment.
And beta.
Beta. Beta attempts to measure a stock's systematic risk, basically, its volatility relative to the overall market. A beta greater than 1 suggests it's more volatile than the market. Less than 1, less volatile.
Uh-huh.
And finally, the equity risk premium, ERP. That's the extra return investors demand for investing in the overall stock market compared to that risk-free asset. It's compensation for the inherent riskiness of equities.
Got it. RF, beta, ERP feeding into the cost of equity or part of the WACC. And then there's this terminal value, that sounds incredibly important because, well, we can't possibly project cash flows accurately forever, right?
You're absolutely right. It is very important. In many DCF analyses, the terminal value can actually represent a substantial portion, sometimes even more than half, of the total calculated value, especially for companies expected to have long lifespans and keep growing beyond our, say, 5 or 10-year explicit forecast. There are two main ways to estimate it.
Okay, what are they?
The first is the perpetuity growth model, sometimes called the Gordon growth model. The formula here is the expected cash flow in the year after the forecast ends, so CFN plus 1, divided by the discount rate, R, minus a constant sustainable perpetual growth rate, G.
Okay, R minus G on the bottom.
Exactly. And a really critical constraint here is that this perpetual growth rate, G, must be less than the discount rate, R. If G were higher than R, mathematically you'd get nonsense, implying the company's value grows infinitely faster than its cost of capital. Economically, it's assumed G should be close to or less than the long-term growth rate of the overall economy.
Right, can't grow faster than everything forever. What's the second method?
The second common method is the exit multiple model. Here, you estimate the value at the end of the forecast period by taking a relevant financial metric in that final forecast year, like EBITDA or maybe revenue, and multiplying it by an assumed exit multiple.
And where does that multiple come from?
Typically, it's based on the valuation multiples you see for comparable companies in the same industry, either currently or what you might expect them to be trading at in the future when your forecast period ends.
Okay, so we've got the future cash flows. We know how to discount them. We have ways to estimate the value beyond our forecast. Now comes what feels like the most subjective and potentially contentious part.
Yeah.
All the assumptions we have to make to even run this thing.
You've absolutely hit on a crucial point. For all its seemingly precise mathematical structure, the DCF model is fundamentally built upon a series of really critical underlying assumptions. And these assumptions, well, they're frequently the source of significant debate and, frankly, diverging opinions among investors and analysts when it comes to valuation.
All right, let's dive into them. What are the key things we're assuming when we build a DCF model?
Okay, first off, we assume a certain level of predictability of future cash flows over that explicit forecast period, maybe 5 to 10 years out. Now, this is a significant assumption because, let's face it, the future is inherently uncertain, particularly over longer time horizons or in really dynamic or volatile industries. We're not expecting perfect foresight, obviously, but we need to assume we can project revenues, expenses, capital investments with, let's say, a reasonable degree of confidence.
Fatal confidence, okay.
Yeah. Based on historical data, our understanding of the business's drivers, our expectations for the industry, the economy, it's a big ask, especially in today's, rapidly evolving business landscape.
That definitely feels like a major leap of faith sometimes. What's the next critical assumption?
Secondly, we often assume a constant discount rate that we talked about throughout both the explicit forecast period and in the terminal value calculation.
Why is that an assumption? It doesn't risk change.
Exactly. This simplifies the modeling, for sure, but it implicitly assumes that the company's risk profile and its capital structure remain relatively stable over that entire time horizon, which in reality might not always be the case. A company's risk can definitely evolve due to changes in its industry, its competition, its debt levels, or just broader economic shifts.
Yeah, that makes sense. Risk is rarely static. What other foundational assumptions are baked in?
Thirdly, the DCF model implicitly assumes a degree of rational investor behavior. It's trying to determine an intrinsic value based on fundamentals.
Right.
And the underlying assumption is that eventually in the long run, the market price will kind of gravitate towards this intrinsic value as rational investors recognize it and act on it. It doesn't, however, directly account for short-term market sentiment, behavioral biases, or, the potential for irrational exuberance or panic that we often see.
So it's still somewhat vulnerable to that casino element we talked about earlier. Could be rational value, but the market price is doing something else entirely.
To some extent, yes, in the short term. Fourthly, when we use that perpetuity growth model for the terminal value, we're making a huge assumption. Perpetual growth at a constant rate, G, indefinitely. Forever.
Forever is a long time.
It really is. And as we mentioned, this growth rate has to be sustainable, typically not exceeding the long-term growth rate of the overall economy. But still, it posits the company exists and grows at this steady pace forever. That needs very careful consideration.
It certainly does. What else is fundamental here?
Fifth, the model generally operates under the going concern assumption. This just means we believe the company will continue its operations for the foreseeable future.
Okay.
This is particularly important when we're projecting cash flows years out and assuming perpetual growth. If there's serious doubt about a company's ability to survive, a traditional DCF might not be the right tool at all. Maybe something like liquidation value analysis is more relevant then.
Right, if it's not going to be around.
Exactly. Sixth, we assume the availability of reliable inputs for the discount rate. We need a representative risk-free rate, a reasonable estimate for the equity risk premium, and appropriate beta. But each of these is itself an estimate.
Estimates feeding into estimate.
Precisely. And they can be subject to considerable debate and variation depending on the data sources and methods used. So even the inputs for the discount are built on assumptions.
It sounds like assumptions layered upon assumptions. Is there one more key belief?
Well, finally, it's a bit indirect, but the CAPM model, which we often use to get the cost of equity for the discount rate, it relies on an underlying statistical assumption related to the normal distribution of error terms in its regressions.
Okay, the bell curve idea.
Yeah. But actual returns in financial markets often don't follow a perfect normal distribution. They can have fat tails, more extreme events than predicted, or skewness. So relying on CAPM can indirectly introduce some inaccuracies into the discount rate itself.
Wow, that's a really comprehensive rundown of the assumptions. It definitely highlights just how much judgment and, well, forecasting is involved, even in what looks like a purely quantitative model.
Absolutely.
Which of these assumptions do you think are the ones most often debated in practice? The ones that lead to the biggest differences in what value people come up with?
Oh, without a doubt, it's the projected future cash flows, especially that long-term growth rate G embedded in the terminal value. That's huge.
The growth assumptions.
Yes. And secondly, the selection of the appropriate discount rate. Those two. Forecasting future performance, especially way out, is inherently subjective. Different analysts will just have different views on a company's competitive edge, market opportunities, disruption risk, long-term sustainability, leading to a whole range of growth assumptions. And similarly, assessing the right level of risk. The discount rate involves significant judgment. It can be influenced by individual risk tolerance, market outlook, the specific methods used. These are the levers that really drive the biggest disagreements in DCF valuations. They have the most impact.
Okay, so we've explored the why and the what of DCF, including those crucial assumptions. Now let's talk about the how. What's the step-by-step process look like for actually building a DCF valuation? Like if you were doing one right now.
Right. The process of building a DCF model, especially what's called an unlevered DCF, which aims to value the entire operating business, follows a pretty logical, systematic sequence. Think of it like constructing a detailed financial forecast, step by step.
So where do you start? What's step one?
The crucial first step is always laying the foundation. This means doing thorough historical analysis and gaining a really deep understanding of the business. We basically assume that the past performance and the company's current strategy give us valuable clues about its future. We try to identify the key value drivers, what really moves the needle financially for this company. So we analyze historical growth, margin stability, how much investment needs to grow, its capital intensity, and the key risks. This means digging into old financial statements, industry reports, company filings, everything you can get your hands on. This groundwork informs everything that comes next.
So understand where it's been, where it is now, what's next after that foundation.
After the historical digging, the next stage is the projection of financial statements and deriving the unlevered free cash flows, UFCFs, for an explicit forecast period, usually, like we said, 5 to 10 years.
Okay, the forecasting part.
Exactly. And this involves several critical decisions and assumptions. First, you have to pick the length of the forecast period. How far out can you reasonably see? You want it long enough to capture key growth phases, maybe until it reaches a more stable state, but not so long your projections become pure guesswork. Then you project revenue growth rates. You might use historical trends, industry forecasts, analyst estimates, factoring in market share changes, competition. Then you project operating margins, looking at history, potential efficiencies, pricing power, competitive pressures.
Lots of inputs there.
Oh, yeah. Then you estimate capital expenditures, CapEx, the money spent on property, plant, equipment to maintain and grow the business. And you forecast depreciation and amortization, D&A, how those assets wear out. And finally, you project changes in net working capital, NWC.
Net working capital. Remind me.
Sure, it's basically the difference between short-term operating assets, like inventory and receivables, and short-term operating liabilities, like accounts payable. It reflects how efficiently the company manages its day-to-day cash needs. Once you have all those projections, you can calculate the UFCF for each year in your forecast. As you can see, it's a lot of interconnected pieces.
It definitely sounds like a complex web of projections. Okay, so you've forecasted the cash flows. What's the next critical piece?
After projecting the UFCFs, the next crucial step is estimating the discount rate. For an unlevered DCF using FCFF, that means calculating the weighted average cost of capital, WACC.
Right, the WACC again.
Yep. This involves figuring out the cost of each part of the company's funding, debt, and equity, and then weighting them by how much of each the company uses or plans to use in its target capital structure. So we need estimates for the risk-free rate, the equity risk premium, the company's beta, the cost of debt, what interest rate it pays, the company's effective tax rate, and those target capital structure weights. For example, 30% debt, 70% equity. We make assumptions for each, plug them into the WACC formula.
We covered those components earlier, so once we have the WACC, what's next?
The next critical stage is the calculation of the terminal value. This is where we estimate the value of all the cash flows expected beyond our explicit forecast period.
The forever value.
Yeah, pretty much. And here we face that key decision. Do we use the perpetuity growth model, assuming that constant long-term growth rate G? Or do we use the exit multiple model, assuming the company gets valued at the end like its peers, based on a multiple of, say, EBITDA?
And that choice matters a lot.
Oh, hugely. The choice between these two methods and the specific assumptions you make within whichever one you choose, like the exact multiple or the precise G, can have a very significant impact on the final valuation.
Okay. And once we have those projected cash flows for the explicit period and the estimated terminal value, what do we actually do with them to get today's value?
Right. Now we get to the core discounting step.
Uh-huh.
We take all those projected UFCS for each year of the forecast and the calculated terminal value, which represents value at the end of the forecast period, and we discount them all back to their present-day equivalents using that WACC we calculated.
Okay.
We're essentially assuming the WACC properly reflects the overall risk of those future cash flows. Discounting tells us what those future amounts are worth in today's dollars, accounting for time and risk.
Okay, bringing all those future values back to today. What does adding them all up give us?
When you sum the present values of all those projected UFCFs from the forecast period, plus the present value, the terminal value, that total gives you the enterprise value, EV.
Enterprise value.
Yes. We assume this represents the total value of the company's underlying business operations, the value available to all capital providers, debt and equity alike.
So that's the value of the whole pie, the entire enterprise. How do we get to the slice just for the common shareholders, the stock price?
Good question. To get from enterprise value down to equity value, and then finally to an intrinsic value per share, we need to subtract any claims on a company's value that have priority over common equity.
Like what?
Typically, we subtract the company's net debt, which is its total debt minus any cash it holds, the value of any preferred stock outstanding, and any minority interests if the company owns subsidiaries but doesn't own 100% of them.
Okay, strip those out.
Exactly. What's left is the total equity value, the value theoretically belonging to the common shareholders. Then, the final step is to divide that total equity value by the total number of diluted shares outstanding. That gives you your estimate of the intrinsic value per share. And obviously, this step assumes you have accurate numbers for net debt, preferred stock, minority interests, and the share count.
And I imagine we don't just calculate one number, like $52.31, and say, done.
Absolutely not, or at least you shouldn't. The final and really critically important step is conducting sensitivity and scenario analysis.
Why is that so important?
Because we have to acknowledge that our initial assumptions are just that, assumptions. They're inherently uncertain. Any forecast is. So we systematically vary the key input assumptions like the WACC, the long-term growth rate G, maybe projected margins one at a time, to see how sensitive the final valuation is to changes in each one, which inputs really swing the result.
Okay, testing the levers.
Exactly. And we might also develop different scenarios, maybe a best case where growth is strong and margins expand, a worst case with recession fears, and a base case or most likely case. This involves changing multiple assumptions together consistently to reflect different possible futures. This analysis helps us understand the range of potential valuations and pinpoints which assumptions are the most critical drivers, giving us a much more robust sense of the valuation's uncertainty.
It sounds like each step is built on the last one and relies heavily on those assumptions and decisions. Like an error early on could ripple through the whole model.
That's a perfect way to put it. The interconnectedness is key. If you're overly optimistic about revenue growth early on, that likely means you'll project higher needs for working capital and CapEx later, which affects your free cash flow calculations, and boom, it cascades down to the final valuation. And that transition point, moving from the detailed year-by-year forecasts to the much broader long-term assumptions baked into the terminal value, that's a particularly critical juncture. That's where the narrative about the company's long-term future really takes over and can massively sway the overall result.
Okay, so we've diligently built our DCF model, we've run sensitivities, we have a range, but how do we actually assess whether that value range is, reasonable, reliable? How do we judge the quality of our own results?
That's the million-dollar question, isn't it? Evaluating the accuracy of a DCF isn't quite like checking if a weather forecast was right.
Yeah.
The model estimates intrinsic value based on fundamentals, not short-term market price swings, which can be driven by sentiment, news flow, all sorts of things. So we have to rely on more indirect methods and cross-validation techniques.
Okay, so what are some of these indirect methods? How can we check our work, essentially?
Well, one really common and insightful approach is reverse DCF analysis.
Reverse DCF, how does that work?
Instead of starting with your assumptions to get a value, you start with the current market price of the stock.
Yeah.
Then you work backward through the model to figure out what underlying assumptions about growth, margins, discount rate, etc., would be required to justify that market price.
Oh, okay.
Then you can step back and ask yourself, are those implied assumptions plausible? For example, if the current stock price implies a perpetual growth rate of, say, 6% forever, and the long-term global economy is only expected to grow at 2–3%, that might suggest the market's expectations are, well, maybe a bit too optimistic.
That makes sense. Sort of a reality check against the market price. What else?
Another angle is observing long-term convergence. While short-term prices bounce around, if a particular DCF methodology consistently identifies companies whose market prices over a longer time horizon do tend to move towards the estimated intrinsic values, that can provide some validation that the model is useful for identifying mispricings. It's about the long game.
Right. And you mentioned ranges earlier.
Exactly. We should really be thinking in terms of valuation ranges. Given all the uncertainty in the inputs, a good DCF analysis, especially with sensitivity and scenario analysis, should produce a range of potential values, not just a single point. If the current market price falls within that reasonably derived range, it can offer some comfort, some support for the valuation.
Are there any other ways to gauge if the DCF is reliable, maybe in the context of actually making investment decisions based on it?
Yes, indirectly, through performance. If an investment strategy that consistently uses DCF valuations to pick stocks leads to good long-term results, maybe high risk-adjusted returns measured by Sharpe or Sortino ratios, or lower maximum drawdowns.
Okay, investment metrics.
Right. If the strategy works over time, it suggests that the underlying DCF model is a useful tool for identifying potential mispricings and informing those decisions. The DCF is the basis for this strategy, and the portfolio's performance gives you feedback on how well that basis is working.
So it's not just about hitting a specific price target next week.
Precisely. It's more about the robustness of the process and the long-term track record of decisions informed by it. And really importantly, we should always employ a comprehensive cross-validation strategy.
Cross-validation, what does that involve?
It involves several techniques together. We already mentioned sensitivity analysis, tweaking one input at a time, and scenario analysis, changing multiple inputs consistently. But critically, you should also perform a comparison with other valuation methods.
Like what?
Like looking at comparable company analysis, CCA, how are similar public companies valued? Or precedent transactions analysis, PTA, what have similar companies been acquired for? Maybe other intrinsic methods like dividend discount models, DDM, or residual income models.
Yeah.
If your DCF value is way out of line with what these other methods suggest, you need to dig in and understand why. Is your DCF making heroic assumptions the others aren't?
That makes sense, triangulating the value.
Exactly. You can also do historical benchmarking. How does the valuation compare to the company's own historical valuation levels? And look at the implied multiples from your DCF, like the implied PE ratio at the terminal value. Do those look reasonable compared to history or peers? It's a sanity check. And finally, if possible, getting peer review or an independent assessment of your model and assumptions is invaluable. A fresh pair of eyes can often spot biases, errors, or things you might have overlooked.
You also mentioned Bayesian inference briefly before. How does that fit into validating a DCF model? Sounds statistical.
It is. Bayesian inference offers a formal way to update your confidence in a model based on new evidence, like backtest results.
Okay, how would that work?
Let's say you have a prior belief. Maybe you think your DCF model is, say, 60% likely to be useful for finding undervalued stocks. Then you run a backtest on historical data, and it shows a certain success rate. Bayes' theorem lets you combine your prior belief with the likelihood of getting those backtest results, both if the model is useful and if it isn't, to calculate an updated or posterior probability of the model's effectiveness.
So it quantifies how the evidence changes your confidence.
Exactly. But, and this is a big but, backtesting has limitations. The past isn't always prologue, markets change, and how you define success in the backtest matters a lot. So while Bayesian methods can be a helpful tool for thinking about confidence, they shouldn't be the only basis for validating a DCS. It still comes back heavily to the quality of the assumptions and the analyst's judgment.
So it really sounds like assessing the reliability of a DCF isn't one single checkmark. It's a multifaceted process involving numbers, judgment, comparisons.
That's exactly right. Confidence in a DCF valuation doesn't really come from a single metric. It comes from a holistic assessment. Are the assumptions reasonable and consistent? Is the model robust across different scenarios? Is it supported by evidence from backtests, other valuation methods, peer review? It's the whole picture.
Okay. So, as we kind of wrap up our deep dive into the discounted cash flow model here, what would you say are the key opposing viewpoints? The main areas where disagreement really pops up when people use this tool.
Well, the primary areas where you see opposing viewpoints, as we've sort of touched on throughout, really stem from that inherent subjectivity. Trying to predict the future and picking the right inputs. There will almost always be differing opinions on the future growth rates for a company, both during that explicit forecast period and maybe even more critically, that assumed perpetual growth rate. Use it way out in the terminal value. It's a big one.
Right, growth is always debated.
Always. Similarly, the discount rate, the WACC, or cost of equity, which bundles up various risk assessments. That's another major area where analysts can arrive at substantially different numbers based on how they interpret risk, what data they use, what methodologies they prefer.
Okay, growth and risk.
Yep. And finally, the methodology for the terminal value itself. Do you use the perpetuity growth model or an exit multiple? The specific assumptions within whichever method you choose, the exact multiple used, or the precise long-term G, those choices, can lead to really wide divergence in the final valuation people end up with.
It really underscores that idea that the DCF model isn't some kind of magic formula, is it? It doesn't just spit out the single correct answer. It feels more like a framework for thinking.
Precisely. That is the key takeaway. The true aha moment, if you will, for anyone really engaging with DCF shouldn't be believing it gives you a perfectly precise, guaranteed intrinsic value. That's not it.
What is it then?
It should be the realization of both the power and the inherent limitations of this fundamental tool. It's a rigorous framework, yes, for structuring your thinking, for translating a story about a company's future into a number, a quantitative estimate of its worth today.
Okay.
The real insight, the real value, comes from understanding how sensitive that final number is to the assumptions you fed into it. It comes from critically, thoughtfully analyzing whether those inputs are plausible, rather than just blindly accepting whatever number the spreadsheet spits out.
So for you, the learner listening in, who maybe wanted that quick yet thorough understanding of this investment cornerstone, hopefully this deep dive gives you a really solid foundation for critically evaluating DCF analyses when you see them. And while, we haven't offered specific stock tips or laid out a concrete investment plan today, truly grasping the mechanics and especially the inherent subjectivity of the DCF model is absolutely crucial. It's crucial for making your own informed investment decisions and for seeing the strengths and weaknesses of different strategies that rely on this powerful but assumption-driven tool.
And this brings up a really pivotal question for you to think about further. Considering everything we've discussed, the history, the mechanics, the assumptions, the validation, which single assumption within a discounted cash flow model do you personally believe has the most significant potential to influence the final valuation? And why? What makes that particular assumption so critical in your view? Something to mull over.
Definitely something to think about. And if you found this deep dive into the intricacies of the DCF model insightful, valuable, and you're eager for more of these in-depth explorations of complex topics in finance and investing,
We hope you are.
then be sure to subscribe to the deep dive. That way you'll get the fastest and most frequent updates on all our future deep dives.